Vincenzo's Gold Crypto Investing, and this is a housing market update. Just so you all understand, old Vincenzo, me, that's right, old Vincenzo has been telling you since we came on the air a little over a year ago and said that we're printing, quote, we're printing ourselves into an inflationary depression with what was going on in March, April, and May in all of 2020 and 2021. We're telling you that we're going into an inflationary depression, and just so you guys understand what a depression is essentially it's depressed growth, right? And it causes economic turmoil. If there's no lending, there's no borrowing. If there's no borrowing, there's no business happening. If there's no business happening, everybody goes broke, right? And you have a liquidity crisis. A depression is a major downturn in the business cycle characterized by sharp and sustained declines in economic activity, high rates of unemployment, poverty, and homelessness, right? You're already seeing high rates of poverty and homelessness, but the unemployment rates are manipulated by the criminal gangsters that I told you repeatedly that have infiltrated the trading markets, Federal Reserve, and the United States government in order to manipulate the markets, right? And one of the ways they manipulate the market is by manipulating the unemployment rate. And how do they manipulate the unemployment rate? They simply say, if you are looking for a job and you've reached the 12-month status of not finding a job, even though you don't have a job and you're still looking for a job or not, but even if you still are, you are not classified as unemployed anymore. See how that works? So hence the unemployment number gets manipulated and it looks a little bit better than it is. But the homelessness is hard to hide because they're all over California, all over Oregon, Washington, and all these other socialist, Democrat, communist states. There's homelessness running rampant, right? Increased rates of personal and business bankruptcies. You've seen this in 2008 and you're going to start to see this again now. Massive decline in stock market. The stock market, after the Fed has stopped printing massive amounts of money, it started to go down, and a great reduction of international trade. You're starting to see that as we're importing massive amounts, but we're exporting next to nothing, and capital movement. A depression may also be defined as a particularly severe and long-lasting form of a recession, where the latter is generally understood relative to a national economy as a period of at least 2 consecutive quarters of decline in real inflation-adjusted GDP or gross domestic product, according to the National Bureau of Economic Research, which maintains records, cycles, peaks, blah, 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 dating back to 1854 of manipulated data, right? So that's what a depression is, right? And it's very important to understand what that is, and that's exactly where we're going. And then let's see if they give you, they don't give you inflationary depression. I think that's just a word I'm making up. I'm putting both of them together, and what I mean by that is you're going to have massive depressed price or deflation in stocks, real estate, and you can start to see where we're going into this housing market. A mortgage industry layoff buyouts ramping up in Metro Detroit. Des Moines private employer Wells Fargo cuts jobs as mortgage business slows down. Detroit, Rocket Mortgage to trim workforce. Wells Fargo, you're starting to see these go on across the country. As if you look at Detroit, because the refinances are slowing down, right? These scumbags, Detroit Free Press, they should let me read. They won't. They want you to sit there and pay. The refinances are down 60-70% year over year, right? If there's less refinances, you need less people to shuffle the paperwork in these mortgage departments, and that's what's happening. Banks are doing less refis. Banks are doing, I think year over year, home sales combined with refis, combined with purchases are down 50%. That means you have 50% less work to do after a 2-year extended blow off top boom bubble by the government printing money and keeping interest rates at artificially low rates, historically low rates, all-time low rates for 2 years. So as that demand goes away, that's the same one I just said. As that demand goes away, you don't need as many workers, and you can see the country's largest lender is looking to reduce its workforce amid a shrinking. And nobody's seen this coming, and still nobody understands the implications when you look at the propagandist mainstream media. Come on. So let me read this fucking article. Pardon my French. The country's leading lender is looking to reduce its workforce amid a shrinking mortgage market following 2 years of record loan volume. Officials said Monday the Detroit-based Rocket Mortgage and Amrock, its title company, are offering voluntary buyouts to 8% of its workforce. Rocket Company, which includes Rocket Mortgage employees, 26,000, mostly in Detroit. The affected employees are primarily in the Rocket Mortgage operations team, blah, blah, blah. You can see that's bad news, and that's starting to go on all over the place, all over the country, and it's going to continue to go on. As you can see, the monthly supply of homes, if you remember last year, in March, April of 2021, May, down here, this was below 3%, and Vincenzo had an end-of-the-year forecast of it hitting 8%. And it got all the way up to 7, so we got pretty damn close. And then it had a little consolidation, and now it's starting to come up. And I think, like I said last year, by the end of 2022 into 2023, you're going to be north of 10, and you're going to be threatening all-time highs as the home supplies get near all-time high, meaning they're on the market and nobody's buying, with interest rates rising to nearly 7% last week. Now they're down to 6% this week. But I think interest rates on a 30-year fixed are going over 10%. As the U.S. Treasuries, the 30-year Treasury got over 3%, right? I think that's going to get to 5%. It's a big problem. And you can see, just if you look at the producer price index, since March 2020, we're up 1.4%, and since March of 2021, year over year, we were up 11.2% in producer prices, and the producers have to produce everything the home builders need to build homes, and that's becoming more expensive, right? So that means it's going to become more unaffordable for people to build new homes, hence they're going to start building less new homes because they can't afford to build new homes. So you're going to start to lay those people off too, and it's a cascading effect, right? One big cascading effect. Consumer price index, another one. What is it costing consumers to buy, right? Another disaster. It's up 1.2% from March of 2020 to the next month. So 1.2% a year. Extrapolate that out for 12 months in a year. You're looking at 15% consumer price index, right? A year-over-year inflation after 10% last year, right? And you can see, going into my inflationary depression theory, food up 8.8%, energy up 32%, all other items up 6.5%. These are the two big commodities. Energy, food are going to continue to skyrocket as other assets deflate, right? That's what I think is going to go on. Houses, stocks, real estate. Let's look at, what else do we got here? Benefits, wage, earnings. But I think it's going to be a disaster, and I've been warning you of an inflationary depression, and you can start to see how this is happening, right? Look at all this stuff. Let's see, state unemployment, nobody cares about that. Import-export prices. Let's look at... Where was the good? There's one that I wanted to show you guys. Let's go to the CPI home. Where was this at? I don't know where it was at now. We've seemed to lost it as I started. There we go. This is what I wanted to bring up. I like this. This is a good graph. So let's look at 12-month percentage change consumer price index. You can see overall it's up 8.5% inflation. But let's look at the ones that I think are going to continue to go up. Energy, up 32%. Electricity, up 11%. Food, up about 8%. Natural gas, up 21%. Commodities, less food and energy, so just commodities, up 12.3%. All the things that I've been telling you are going to continue to inflate are inflating. And now you're starting to see the chinks in the armor. And in the housing market. And this is a chink in the armor. These are warning signs that the banks are laying off. Wells Fargo layoffs likely impact all markets. Analysts say Charlotte Business Journal, right? The Wells Fargo starts layoffs in home lending units. You've seen another red flag that happened about 6 months ago, right? Zillow. The Zillow home flipping, how did that work out? Not too good. Zillow sells 2,000 homes and dismantling its house flipping. And you can see that was at November of 2021. This was another pre-warning sign. These are all things that if you know where to look for the warning signs, you can see what's going on. And you can put, if you know where to look, what to look for and how to look for it, you can see the warning signs being fired off from everywhere. Interest rates rising, 30-year treasuries rising, 10-year treasuries, government yields, right? The bond market rolling over, right? Like, look at the bond market. Why bond market crash is actually good news. Propaganda, but you can see bond market crash. And the bond market collapse is accelerating April 6, 2022. As long anticipated, the bond market is collapsing, having wiped out over $2.5 trillion in financial wealth. $2.5 trillion in financial wealth gone as the bond market collapsed. So you got the bond market collapsing. You got bond yields rising, causing the bond market to collapse, which is also causing interest rates to rise on homes, 30-year fixed rates up to 7%, right? Home supply starting to skyrocket, mortgage companies laying people off, banks laying people off, right? Tech companies firing people and laying people off left and right. All the warning signs are there. The bond market crashing, the stock market topping out, and the Fed continuing to tighten monetary policy in the face of what's going on. It's going to cause a massive financial collapse on historic proportions that we've never seen. It's going to make 2008 look like a piece of sweet apple pie, right? In comparison to what's going on now, and you need to be prepared, and you need to start putting the dots together and seeing what's actually happening. Like, subscribe, and share. Peace and love. Peace and love.